What's up everyone, welcome back to Bangkok in Thailand once again. Today I want to show you how to trade reversals in the Forex market. We'll go through some strategies I have, some trade setup, I'll show you some live examples in the market. And that way you can understand more about how to trade these reversals in the market. Now reversals are, for most traders, not working very well. They try to pick the top, pick the bottom, it doesn't work well for them. So we'll dive into that, why it doesn't work, how you can flip this around, and hopefully you can learn something useful. So without further ado, let's dive right into the charts. What matters a lot when you pick reversals in the market is to look at the context in the market. You know that a setup by itself doesn't mean that much in the market. It could be good, it could be bad, it could be winning, it could be losing. But a setup is just a setup. It doesn't mean that much. We don't know much about how the market's behaving before. We don't know much about where the market's going. We just know that we have a setup in the market. So what I want to teach you here that's really the key and the most important thing of this whole video is that in any market, the context is a lot more important than the setup. You could have a really bad setup or like just an average setup at a good place in the market and you can win a lot of money on that trade. So it's all about the context over the setup. We need to be able to see what's the market doing right now. Is it consolidating? Is it reversing? What kind of phase it's in? And that's really what I teach my students a lot, is to look at the market phase, the market context first, and then we can dive into other setup, other strategies and things we can do to look at trade. Now from here, what I like to do a lot is I like to look at some kind of like framework to look at my trades. And the way this goes is here you have a lot of trades that you could pick all these possible trades you see in the market. But then we're going to filter these out to where as we go forward, like we'll just have a couple of trades here that we can take. But as we figure this out and as we get closer and closer, we have only a couple of trades we can take. And these will be what we call high reliability trades. Okay, that's what people love to call them. I don't call them high reliability, I call them just filter trade or trade that have more confluence in them. Okay, so this is really about confluence. Okay, so these trades, what this means is that these trades are more reliable than any trade you would take over here. Okay, you can have a lot of trades that you would take, but as you go forward and you filter them, then you have a lot less trades you can take. But these will be more confluent, so you have a higher win rate with those, and they tend to produce bigger moves in the market. Those are the ones you want to be able to focus on. Okay, not the one here before, but the ones over here. Now, from here, what we need to do is we need to look at, like we said, the context. And we start this with what I call the principle of market phase. Now, I didn't name this. It's a principle that Stein Weinstein discussed in his book before. I think it's called Strategies to Win in Bull and Bear Markets. I'll put a link below for that if you want to check it out. Old book, but it still makes a lot of sense today. So we look at this thing first here. Then we go forward and we'll go into zones in the market we can trade. Okay, this is going to help us figure out in any given context, any given market phase, where are the zones, the locations in the chart where we can place trades. Okay, that can depend on many things, but we'll go into that. So here will be the zone. Then we'll look at, from those zones, what is price action doing in the market. Okay, price action, you know, I love price action, it's important, it's a really good concept, but we need to look at price action within a certain context. We cannot just take any kind of chart, look at price action, then take a trade. That will result in losing trading for sure. You want to have price action in a context because that's where it makes sense. Like, let's say you spot a nice reversal candle. Okay, the best candle you've ever seen. But it's like in the middle of a range. It doesn't mean anything. It could be going both ways. You wouldn't take that trade. If you take that trade, then you'll be probably stopped out. The market will be choppy a lot and not good for your trading, of course. So we want to be able to avoid this by looking at the context first and then price action after. Now, the last thing I do for myself, because I like to be very systematic, very rule-based, I don't like to have discretion in my trading too much, is I look at indicators. Now, indicators are simple. It's like, for me, it's like a surgeon always use some tools when they do surgeries. Then why wouldn't a trader use some tools? It's not like your hands in the surgery, like you won't feel things with your hand. It's a second measure. It's just an instrument, but they will help you make a decision based on data and not opinions or not feelings in that case. These are very systematic, so very good for my trading in that case. I always pick only one indicator. Okay, you can go with 2, 3, but I don't see the point of that. I pick one indicator, I'm good with it, and that seems to work well for me. So now we have this framework. Now all we gotta do before we go on the chart is we gotta fill this in with some information of what we will actually trade. We already said we're gonna trade reversals. So reversals are traded only in ranges. They are not traded when the market is trending. Okay, that is the worst thing possible. If you're gonna see a market trending like this, and going up and up and up. You don't want to be the guy selling here as a reversal, because then the market will probably stop you out. That's not the point. Okay, that's a really bad way of trading. Instead of what we do is not this, is we want to be able to trade reversals only in a consolidation. We need to have either the same lows or the same highs or both. So what it could look like is something like very, very classic, something like this. Price going within the range, and then we'll be basically trading these reversals over here of the range, at the bottom and at the top. Now that's of course the textbook example. That's very basic. You've read this everywhere in the past. Okay, so we could put some zones here. This is what we could trade in that case. But sometimes it's not as textbook and clear. Sometimes it's different. So how it works in some cases is you could have the same lows but different highs. For example, you would have the low over here. Price would make some random highs that are like this, but always the same low. Okay, we see this a lot in the market sometimes, especially the Japanese yen does that a lot. We want to be able to, in this case, only buy the support. We don't want to be selling here because the highs are always different. Sure, you could like draw a trend line if you want and trade in this way. I don't particularly like that myself. I prefer to look at the same level, like a horizontal zone in that case. For me, that works better. But we'll be buying here this support in that case. Okay, so these are the contexts we can trade. And same thing, of course, we could have the inverse of that, which would be the same highs but different lows. So price could go over here, tap this resistance, go back here, tap this like this, and so on, and make like very weird lows in that case. That's fine too. We want to be able to, in that case, we would like to sell the resistance. Okay, so that's how we would do things here. Now we need to understand this because any trade that happens here, or here, or here, or somewhere here, or even here, this looks like a cool reversal, but it's not reliable in this case. Because price could, in this case, go both ways. It could go down or it could go up. Okay, we cannot know which one is going to go. In this case, of course, price could go up, could break out. But we have more chances if you have a nice reversal set up that price will go down and go back within the range. It's just how markets move. They tend to go back to the mean. They tend to mean revert, which is go back within the range. And here, so we have a better chance here than here in the middle. So that's what we are doing. Okay, so we talk about here the market phase. So we want to only be trading based on reversals, right? We said we would trade reversals. So in this case, we only want to be able to trade ranges. So this is reversal, this is going to be ranges in this case. Okay, that's the only thing we'll look at and we'll trade. And again, when we say ranges, we mean by the zone. We'll look at support and resistance areas in this case. Okay, nothing else. We just look at these zones. Sure, you could use trend lines. I don't. I use support resistance areas or horizontal, like I said. Both ways work. Like you can do whatever you want, but I'm sharing what I do myself, and then you can use that to your own trading if you wish, of course. Okay, so support resistance areas. We have this here. Next, we'll look at some price action. Now, here is simple, right? You've read these books before. You've read the Steve Nissen Japanese Candlestick Patterns book. You've read other books. You've maybe taken courses from like Urban Forex or whatever. Whatever price action pattern that you want to use that is showing a reversal, you can plug it in here. Okay, in my case, I look at engulfing candles a lot. You could be looking at head and shoulders if you want. There's so many ways you can look at this. You can look at a mix of two things. So head and shoulders, engulfing candles. You can look at pin bars. You could be looking at any kind of move you like, any kind of pattern. Okay, I'm not gonna like discuss all of them here, but anything you like. By the way, the cool thing about this is that this framework here, no one ever talks about this online. Okay, you never see any video on this. This is really hard to find. These things here, market phases, not too talked about, but these things are talked about everywhere online. You could like find a book on this. You could find any video on YouTube if you want. All the even like the figures talk about this stuff. This is very common, so you don't have to search very far to find these things. Find out the YouTube video, watch these things, and then you'll be able to know what to plug in this right away. But the key thing is that these have to align with the kind of trades we're going to take. In this case, the reversals and the market phase and the support resistance area. So you don't want to, let's say, trade pennants in this kind of category. Pennants are reserved for trend trading. You don't want to trade flags, same thing, or triangles. These are reserved for trend trading in that case. You don't want to look at like these kinds of patterns that are very more like subtle, that are smaller, and that tend to be used for like a pullback or something. These have to be used for reversals. But you can just search in Google price action patterns for reversals. You'll find a bunch of stuff there. Okay, so very simple. So engulfings, let's pick another one. Let's go with head and shoulders. We'll just keep those for now. That's fine. Okay, next is indicators. Now again here, this is optional, but I highly recommend if you want to have a rules-based systematic trading, we want to pick an indicator in the market that is identifying reversals. So not moving averages, not all these other trend-based indicators. It's something that can show us extreme points in the market. The RSI is a good example. The Bollinger is also a good example. Obviously stochastic. The ADX could not be used for that because that's for trends. But all kind of indicators you want to use for trading markets. Again, if you want to learn more about indicators, there are many websites covering those. This is very popular out there. You won't have a hard time finding those. I'm giving you here the principle because it's more valuable in my opinion, but then you can do what you want with it. So here we'll go with, let's example with Bollinger Band. And I think we'll just cover Bollinger Band here because that's going to be plenty of stuff to look at. Again, this is optional. I'll give you maybe an example with no indicator and then one with indicators. You can see the difference here. But that's how this would work over here. Okay, so now we have our principle, we have our framework here. Now we can just plug this into a plan, make sure we have this written down somewhere so it's clear to follow. And then we can jump on the charts right away. Okay, so here I'm on TradingView. Again, the best platform out there for your trading. If you're not using this, I don't know what you're doing at all. It's a waste of your time, but let's just dive into it. This is the best platform out there. So now let's have a look at an example here on GBP/USD. Now we'll look at the market phase first. I always recommend 2 time frames higher than the time frame you trade. So if you trade a 1 hour chart, you want to go on a 1 will be forward, then 2 will be daily chart in this case. You can even go on a weekly chart if you want, but 2 time frame is, for me, it seems like the sweet spot of this. So I'm going to trade here in a 1 hour chart, for example. I'll go to see on a daily chart. Okay, so now what we want to do is we want to identify the zones where market is likely to reverse. We need to have a range, and we need to have a zone within that range to look for reversals. I'm going to zoom out in the chart, and what I'll see is that we have price bouncing between levels. Okay, we have this level here, that is a round number 1.33, a very reliable level where price bounced in the past many times. We have this other one here at 1.28 or so, or 27.5, where price bounced many times in the past. But if we see here, price is kind of like within the range for the past couple of years. Actually 2019 or so. We've been here at this level, we bounced many times, right? This is 1.21. We bounced here, came back up, bounced here, came back up more, and then right back to bounce to the same level again. So if you look at the weekly chart, it's going to be clear. Sometimes I like to go higher a little bit to have a better picture of things, but it's clear that price is doing a range between 1.42 and 1.21. Like it didn't go below at all. It came back here the same day after when it went below. But we don't have any big move outside of that range. So good place here to look for a bullish or long setup in that case. But now the next step will be to zoom into this because we don't want to trade on the weekly chart. It's going to be hard to place any trade that's going to be giving us a quick profit. We want to be able to go on a lower time frame. In this case, we chose a 1 hour chart to look for setups. So I'll pick this example that came up recently, and I'll just add here the Bollinger Band to the chart so you can see better. Bollinger Bands is going to be a quick, rapid, very short introduction of it. Shows us 2 bands, the top one and the lower one, and then we have of course the middle one, which is a simple moving average. The extreme band, the top and lower band, shows extreme points in the market, and this is going to be a 2 standard deviation. Okay, so 20 and 2, 20 period and then 2 standard deviation. What that means is that you can read that 95% of the time, the price or any given data basically should be within standard deviations of 2 at least 95% of the time. So 5% it will be outside those bands, 95% it will be between those bands. So it's a good sign that if price goes outside the band, it will come back within the band eventually, pretty soon. It's not going to stay there for that long in most cases. Okay, so we know that if price goes here outside the band, it will likely come back within the band. Okay, good example here. Price was here, came back here, and then even went below. Price was here, again here we went a little bit outside the band for a while, but soon enough price comes back within the band. Now it doesn't mean you have a trade for all these places where price goes outside the band, doesn't mean that. This is an indicator here showing the mix of going outside the band plus an engulfing candle. That's all, that's very simple. Okay, so I'll look at these setup here because that's what I trade myself. But I'm not going to trade all of them. These have to be in line with the market phase first and then the zone. Price goes outside the band, comes back within the band over here. Price is outside, comes back within, and so on. You have a bunch of examples here. But what I'm looking at is, let's say we are here. We have our level in the past, but the main key level we looked at was 1.21, remember, on the weekly chart. Now we want to have price going to that level first, and then we'll look for trade. So let's just have a quick look at this. I'm going to take this off. And let's go here into a replay mode, which I have not done in a while. Here we are. Price is not at the zone yet, but we are sort of like getting there slowly. Okay, we're still at 1.23 or so. This will take time to get to the zone, of course. It's not gonna happen in just one day. And just keep that in mind. And then we'll just go like forward with this. So here we are. And here we seem to be in the zone, right? I always give myself some buffer. So roughly around 50 pips above 1.216. Then a little bit like 50, 60 pips below in that case, depending on the pair. So that price, if price goes there, it's still in the zone. It's not at the exact level, but it's close enough to take any trade. Okay, price consolidate a little bit. Comes back. We're still not in the zone yet. We are still a little bit outside. So if you take a trade here, it's a bad reward to risk. But here we are at the zone, right? We touched a little bit within that range. Again, this is a fairly kind of discretionary zone. You can do it however you want. I'm seeing on many pairs that it's either between 60 pip and 100 pip of buffer in that case. Here 1.269. So roughly around 60 or 70 pip in that case. Okay, now we have our setup, which is a good sign in that case. We are at the zone. Again, like we could be a little bit higher, a little bit below, doesn't really matter here. But we have a engulfing candle, which shows us that now the buyers are getting in control compared to before was the sellers, and we are consolidating anyway before that. And we are breaking the Bollinger Band. Now Bollinger Band here is really tight, which could indicate some kind of breakout in the future of the Bollinger Band. Could be to the top or to the bottom. So when you have the Bollinger Band here narrowing quite a bit, right? It's a lot narrower than it was before. Then we are seeing some kind of consolidation in that case. Could have a breakout to the top or to the bottom, but it doesn't matter for me. What I really look at here is this engulfing candle in that case. And it shows us a clear bias by the buyers here. That is complementing the fact that we are at a support area, which is very strong. Price has never been there before in the past couple of years. And we are likely to bounce back up. So my bias here is long. Therefore, I would take a trade just above the high of the engulfing candle, put my stop loss below the low, and I would try to target, and it's kind of how I do it myself, it could be different for you of course. I look for a 1-to-1 reward to risk for my first take profit, and then a 3-to-1 for my second take profit. So that way I'm able to catch a quick kind of break even here when price reaches 1-to-1, and then I'll be able to either trim my stop loss to like further and further, or just hit for a 3-to-1. It depends on how I feel about this pair, but here in this case we'll just go with 3-to-1. And we will show you the example of trading later. That's possible, or in a different video. I've done that before, of course. Okay, so now what we'll do is we'll just put our thing here for the trade. We enter here right above the high, stop loss below the low, give it a few pips to be safe. Then 1-to-1, okay. And then the 3-to-1 is here. So the cool thing about 3-to-1 is that you can have a really bad win rate, like a 30% win rate, and still make a lot of money in that case, okay. This is just a first half we take off to be safe about our trade. So now let's see how price evolves in that trade. Here we are in profit a little bit. Okay, price going back. And I'm just gonna try to speed this up a little bit for you, so you can see. Okay, our first take profit here was kind of reached by a wick. Pretty good, we're going back down. Now I would prefer in that case not to move my stop loss to break even because of the fact that we are in a reversal. Price is normally gonna pull back in a reversal many times. And it's not gonna be like in the trend going all the way straight up quickly. It will come back many times, so that's expected. I'll just leave it like this. Same stop loss, but we only have now half of the trade open. And we continue more. And here we go. Past the 1 if we didn't close it yet. And boom, right? You see how price, when it got away from the zone, it just pushed straight in the direction. This is a good example of combining a trend to a original reversal. Okay, very good sign here of this trade. Now you could decide here because it's such a big push, especially when you see these kind of candles here, that price is trending now, so you don't want to have the 3-to-1. You might want to cancel that trade if you want, because you see like price has made no pullback basically in the past, except over here, and it's not trending strongly. So why close the trade once in the trend? We could easily here trail or stop loss. Now again, it depends on your personality. Some people will do it, some people would not do it. Go with what you prefer. I'm not here to give you some rules and like exactly what to do. Do what you feel is best in that case. You are the trader behind the screen after all. So let's say we go into trading mode where we'll take off a take profit here and trail or stop loss. Now we see price made a big push, and what I would do in that case, I would move my stop loss to the nearest low over here. We know if price goes here, that it's likely that the trend is dead. It's not gonna go back up anymore. It just completely failed to trend. So we'll leave it like that. Then we'll move forward a little bit and see when price makes a new low. Okay, here we consolidate, pretty good. We'll leave it like this for now because we don't want to be too close from the price right now. We don't want to move a stop loss right now. It will be pointless. Let's see what price does. Goes back down. Okay, makes a new low. Goes back down. We were not hit yet. That is a good thing. Let's continue. And okay, here we make a new low. Like, price is a bit choppy here. If you're stressed by the price going back against you, just go on a higher time frame and trail from there. You can go on the forward chart and we can be trailing from there instead. This looks just like a normal pullback, but on the 1 hour it's kind of scary a little bit. But here it's better. So let's just go like that to be safe and to kind of give us some room. Okay, we have a low here. We are not stopped out yet. We'll leave it like this for now. Let's play this out. Okay, now price makes a new high. You see, we have this high here similar to the last one. This high here higher. We are in the trend. I would like to move my stop loss here to just this low over here, so that if price comes back here when it was trending, it's stopping. It's not good anymore. And then we'll just keep like that. Okay, new high, come back up for a low, a higher low than before. Let's keep going. We are pushing back up. Okay, higher high again. Now it's risky a little bit here, but I might want to push and move a stop loss to here. In this case, if price goes here, well, the trend is probably stopping. Let's continue. Higher high again. Cool. Our stop loss is good. And this is where we are right now. So if you decide to trail your stop loss, you will be still in the trade with roughly a 3.5 to 1 reward to risk. So pretty good here in that case. You'll still be trailing your stop loss. This is a more discretionary style, but works really well in the market. Pretty cool trade. You're able to catch a big move from a reversal here. I would try to maybe close my trade close to the zone here. Maybe I would have closed it already because now we are getting near a resistance area. So we don't want to be buying here. We want to be out of the trade in that case. But that's how things would go here overall in this case. Now this video here is getting really long. I didn't expect it to be taking that long to teach you all this stuff. I want to do more examples, but I'll keep it for a different video. If you want to see more trades set up like this, you want to see more examples, leave me a comment below in the comment section. Tell me you want to see more trades. I'll be doing part 2, part 3 and more in the future, teaching you some more strategies, some things I do in the market. I just need your thoughts and I want to make sure you guys like this kind of stuff compared to my original videos of more like mindset, discipline and stuff, and traveling as well. So let me know in the comment section below, and I'll also leave below in the description a link for a video I've done that explains all my strategies step by step. If you want to learn the rules and the things that go behind it, I have a full course. That's a free course on how to master it. Pretty cool for you to learn this if you want. Subscribe if it's not done yet. I publish videos like this 3 to 4 times a week to teach you some trading tips, get you inspired and motivated, and also I introduce some traders on a weekly basis that can give you their thoughts, their experience and expertise so you can learn in trading faster. So hope to catch you here pretty soon. So that's it here for part 1. It's been taking a long time, and I'll see you pretty soon for the next video. Ciao.